Okay, can you see the slide, Justin?
Yes, I can see it.
Okay, can I get started now?
Sure.
Okay, good evening to all of you, ladies and gentlemen. And first of all, we would like to thank you, IFAS, for giving us this platform and the opportunity to share with you some of these market updates in China. You know, in the third quarter of 2021 has been really, really tough for the China equity market. If you look at the performance for July, August, or even September, right, and if you track the performance for dynasty or even the benchmark closely, you will realize that, you know, for the last 3 months, you know, consistently we are getting a negative return. Yeah. So I think it is quite timely as we move to the last quarter of this year, and we are almost at the end of of the month October right now. I think it's good for us to actually take a step back and look at what is actually happening in China at the moment. And if you recall early this year, right, China basically embarked on a very tough decision to actually have this crackdown on the tech giant as well as some of the private education sector. Yeah, and if you look at the way they are doing it is quite systematically, in the sense that, you know, they continue to drive their strategic direction going forward for the economy. And if you look at the last 20 to 30 years, right, China has done an extremely good job in removing or eliminating poverty. And they're actually at a very interesting juncture or crossroad whereby they are trying to fine-tune their economy. So that's a topic of my discussion today. Now I'm going to move on to talk about the market performance on a year-to-date basis. You can clearly see that, you know, in this chart, right, the developed market, the like of US, Europe, global market as a whole, right, even like some of the developed country in Asia has done extremely well on a year-to-date basis in terms of giving very strong positive number. Now, if you're looking for China, right, you don't have to look further, right? Just look at the one at the bottom. Yeah, China equity, especially the third quarter, suffered tremendously in terms of performance. And you know, earlier on, I mentioned about the crackdown on the tech giant as well as the education sector. And in the third quarter, they also sort of look into this property sector. And maybe 12 months ago, you never heard of this company called Evergrande, but I'm sure by now, right, you see this on the news on a daily basis. Yeah. And because of that, on the Asian high yield credit, which is on the bond market, also has suffered quite a bit, especially the third quarter, whereby the Asian high yield credit in general, okay, drop or had a negative about 8.5% return for the quarter itself. So you can see, you know, if you look at the Asian high yield, right, China high yield in terms of the property exposure is quite big in that sector. So because of the significant drop in the high yield market in China, as a result of that, the Asian as a whole has been dragged down. Yeah. Now, having said that, if you look at other asset classes, you know, oil has done very well on a year-to-date basis, simply because I think suddenly you have this demand or in terms of the supply chain catching up. Now, oil prices continue to be a focus of a lot of the investors right now, because initially we thought that this inflation is going to come and go, so it's expected to be transitory. But having seen what have happened the last couple of months, right, and the oil prices continued at a stubbornly high level, and some of the investors actually have second thought about it, whether, you know, this inflation will be here to stay for longer. Now, the other asset class, if you look at it at the bottom of the chart, right, gold prices, yeah. Remember last year, gold prices were the darling in terms of performance. And you can see as the economy continued to recover, right, the demand for gold actually has sort of like dwindled a little bit. So year to date, gold actually registered a negative return. Now, China volatility has weights on the emerging market, because China actually is a big part of this emerging market. Now, if you look at the quarterly basis, right, last quarter actually wasn't a good quarter for most of the sector, as well as the different investment style, like the value or even growth investment philosophy. And only sector like financial, technology, or even to a certain extent, you know, small percentage of the healthcare and energy has positive return. A majority of the sector, like, you know, consumer discretionary, material, industrial, suffer pretty, I would say, mid-single digit or to some extent low double digit sort of return. But if you look at the year-to-date basis, right, most of the sector has done quite well, be it on the financial, technology, even on the investment style like growth, right, especially in the developed market, growth has actually done extremely well, giving you more than a double-digit return. Now, as you can see, right, the developed market and the emerging market in terms of their performance is actually has been diverging. Now, it comes to a point, it's very interesting because, you know, some of these developed market, the valuation is no longer cheap anymore. Whether for China and even for emerging market, right, the valuation become more attractive. So I think the more interesting point going forward is that at what point, right, this emerging as well as the developed market, the performance will start to merge. Yeah, so this is one of the things we continue to monitor. Now, if you look at the performance on the month-to-date basis as of yesterday, and China actually has done quite well. It's actually registered positive, close to about I would say 2 to 3% of positive return. Yeah. Well, I think if you look at the developed market, continue to hovering at the I would say the high level in terms of the index. And more importantly, I think you need to look at in terms of the fund flow. In Asia, right, we saw quite a strong inflow late last year as well as the first 2 months of this year. But since then, right, you can see in terms of the fund flow to Asia, it has been just, you know, swinging between the positive and negative or very small negative sort of growth. So I think it's still pretty muted. I think the interest in Asia is yet to pick up. But I think, you know, after we have seen the divergence in both of the developed and emerging market, we strongly believe that, you know, you may want to start thinking about having position in the emerging market as well as China as a whole. Now, India, on the other hand, has done extremely well in the last couple of months. You can see in this chart here, this is the valuation in terms of price per book. And India definitely, because of the recent rally, in terms of the valuation, is getting a little bit more rich or expensive as compared to the country like China, Hong Kong, or even China, Asia, the domestic equity market. And it's become very attractive in terms of the valuation. Now, of course, Malaysia, we have been, you know, sidelined by a lot of the foreign investor in the last 2 years. But I think if you look at some of this fund flow to Malaysia, the last 2 months, right, we continue to see some inflow from foreign investor in the month of August as well as September. And when it comes in, right, they actually selectively go into some of this cyclical sector, for example, you know, industrial as well as financial. So you can see Malaysian market actually has bounced back a little bit in terms of the stock level. Now, China recent volatility, if you look at this price per book, right, the PE ratio, it actually has come off, you know, from the peak of about, I would say, 14 times to where we are today, about 11 times. And in this retractions, right, we do see some opportunity, especially in the new economy sector. Now, let me just explain to you a little bit what we meant by new economy sector. Those industry that involve in renewable energy, for example, you know, that produce like clean energy, those sector involved in technology, focusing on, you know, develop the own microchips or even though like, you know, processor, and we think that those are the sector will benefit out of this new policy from the government in terms of the support and the policy guidance going forward. Now, if you look at some of the sector, we focused quite a fair bit in the past. For example, on the EV, right? I recall early this year we have very little exposure in terms of the portfolio weights in EV, for example, those produce electric vehicles. And I recall 12 months ago, we don't even have up to 1%, but today, right, we have stepped up the exposure to about 4.5%. So that's how positive we are with this new economy sector. So of course, I think, you know, this retracement currently in the last 8 months or so, right, has also given us opportunity to relook in some of the very attractive stock, and the stock that we think in the medium to longer term will definitely create value for the investor in Dynasty Fund. Now, property sector is a major sector in China, the GDP makeup, and it's a big chunk of it. If the property sector in China bursts, right, the bubble bursts, right, it's going to affect the GDP growth for China significantly. Now, you know, the property saga that we are experiencing right now, basically actually resulted in some of these very weak credit rating developer having difficulty to have access to the funding. I give you an example, you know, because of the credit crunch lately, right? Some of these low credit rating company has to offer coupon up to, you know, 10 or 12% to actually attract the new credit investor to come to buy into their debt issuance. So because of that, we strongly believe that, you know, this process of, going through this property cycle is important. And we strongly believe that, you know, property sector in China, after going through these transitions, right, we strongly believe that they will emerge even more healthier. Now, one of the reasons we think that the chances of this bubble burst is much less compared to the previous economic crisis. If you just look at the chart on the left side, right, and these are the property inventory level, yeah, and compared to the previous peak, and obviously a lot lower than this. And now with the regulator steps in to actually provide guidance to the industry player, we think that there's a pretty good chance that they will survive this particular tough time for the property sector in China. Now, then how about the currency in terms of the Chinese renminbi is doing against the US dollar? Now, on a year-to-date basis or even a quarterly basis, right, last quarter, the Chinese renminbi actually remain quite stable against the US dollars compared to a lot of the regional country in Southeast Asia, whereby most of them are actually depreciated quite a fair bit against the US dollar. I think this is very important because when you have a stable currency, this is where the foreign investor will be more favorable or even a little bit in terms of the foreign direct investment coming to China. Now, let's take a step back to look at the macroeconomics in China and where are they at the moment. Now, on one hand, China is basically trying to clamp down on the shadow banking. As a result of that, you can see the credit growth in China actually has slowed down. And as we mentioned, right, China GDP growth for the third quarter has been quite disappointing. It grew just about 4.7% compared to the previous quarter, about 9.7%. So it's a drastic drop in terms of the GDP growth last quarter, and it's actually below the market expectation of about 5%. Now, having said that, usually in an environment like that, most of the central bankers will start thinking about, you know, easing the monetary policy. But in China, they are not doing just that yet. Instead, I think they are looking at targeted measures, especially injecting liquidity into the system to certain targeted industry that they're looking at. So as a result of that, you don't see the government bonds, the bond yield actually drop drastically. It's still actually maintained at a moderate level between 3.1 to 3.2 level. Yeah, so it just goes to shows you that, you know, in terms of the liquidity in the China financial market is still abundant of liquidity to support, yeah, so they don't have to resort to actually doing the easing of the monetary policy just yet. Now, China actually having a lot of challenges, especially in the third quarter this year. Now, let me just explain to you some of the challenges they have. Number one, stagflation. Now, looking at the term, you probably know that stagnant, you know, the economy is not growing, it's very slow, stagnant, but at the same time, the inflation is actually moving significantly. And probably at the back of the high unemployment rate, you know, in China. So this is very, very dissenting or concerning to a lot of the investor, especially the foreign investor, for the future in terms of the equity performance in China. And on top of that, I think China recently had this power outages. I mean, you know, certain part of China, basically they are without electricity, and that's not very good. Because I think if you look at where they are right now, they're going into the winter right now, and a lot of the region is going to be very cold, and you definitely need, you know, the electricity to actually provide, electricity to the home, and especially to the manufacturing in terms of their maintaining their activity or capacity output. And that is slowed down actually quite a fair bit because of these power outages in China at the moment. Now we just talk about the property down cycle right now. Even though it's not going to be easy, but we do believe that they will be able to just weather through it lah. Now, more importantly, you look at some of these economic indicators, especially in terms of retail sales. Yeah, because of the COVID outbreak, right? You can see even there are still slow growth in terms of the retail sales number, but the growth number has been really, I would say, small compared to last few years. So this is also one of the reasons, with the confluence of all these factors, right, has actually contributed to the very poor performance in the third quarter in terms of the GDP growth in China. Now, let me just show you some scenario where China is at the moment. Now, if you look at the coal prices, right, if you compare the coal prices today, which is in 2021, right, which is represented by the yellow line, the solid line, you can see that the last couple of years, right, basically the coal prices has been quite stable, ranging anywhere between, between, I would say 500 to 700. But you can see starting early this year, especially after March 2021, right, the coal prices just shot up significantly from 600 to where they are slightly above 1,000. So that actually contributed to high inflation in China at the moment. And at the same time, because China committed themselves to the climate change, their commitment to the carbon footprint, they want to, sort of like be able to reduce that by 2030 and, further down the road by 2060, right? They want to achieve carbon neutrality. Now, as a result of that, some of this order coming from the central government is that, you have to slow down your productions. You have to slow down in terms of your coal mining activities. That's why you can see, in terms of the operating rate at the steel mill for 2021 is actually on only one direction, which is coming down. Yeah, they were operating early this year at about 65%, and where they are today is close to approaching about 55%. So which shows that they have a lot of capacity, but they're not utilizing it. Yeah. Now, in terms of the rate, right, anything above 80% is considered as operating at full capacity. So you can see, during those years in 2016 and 17, a lot of these steel mills are actually operating at full capacity, and where they are today, you can look at it, it is only half of their capacity at the moment. Now, if you look at the CPI and PPI number, actually stand for Consumer Price Index as well as the Producer Price Index, you can see a significant divergence, yeah. And the recent peak, right, especially in the month of August, is actually much higher than the previous peak in 2017 or even 2011. Now, the latest number for September is even higher. The number printed at about 10.5%. So you can see that, you have this producer price inflation continue to persist in China at the moment. Now, what about in terms of the future index prices? You can see, in the last couple of years, right, it is pretty much quite stable. And you look at number for 2021, it actually has moved significantly higher, yeah, from where they are early this year, about 2005 to close to 3005 right now. So the problem is real. So these are the short-term challenges that the China is facing at the moment. Now, this map basically shows you that, in terms of the power rationing in China, which particular region are having what specific problems. If you look at the area that is, represented by the black in color, you can see the Heilongjiang, in Liaoning, right? These are the region that actually have these coal shortages. And if you look at the region that is in yellow in color, which means that these are the area affected by both electricity consumption control. That means the government actually tells you can't, operate at full capacity. You have to reduce your consumption or production of that. And look further down, if you look at the red color in Xinjiang or Inner Mongolia, right, it's actually they are the region that hit the most. Yeah, basically they have both problems in terms of coal shortages as well as the electricity consumption control. And those areas in blue, which are a little bit on the rural area, these are the areas they can't even do an estimate. Yeah. So in totality, right, the problem of the power rationing in China is rather serious and severe. But I'm quite surprised to see that Taiwan is actually in the map of of this thing, which is, they actually have limited news flow to access what are the power situation in Taiwan. Now let's go back to the property for a moment. You can see in this chart here, right? Since early this year, you can see the trend in terms of the sales number. It has only one way down, yeah. But I think the good news out of this declining trend is that in terms of the average selling prices, yeah, especially in the primary market in China, they look at 70 different cities, right? In terms of the ASP, they are still holding up quite well, yeah. And coupled with the fact that the inventory is not very, very high. So I think the chances of the bubble burst, as I mentioned, the probability is a lot less compared to the previous market crisis. Now, I think I want to focus on my presentation to talk about the China, the next 5 years for them starting this year. Now, I think China already went ahead to plan for their 5 years from 2021 to 2025, and they actually set very specific KPI or target that they want to achieve. Number one, they want to have a very quality economic growth. That's why they put a range. They don't, like in the past, right? They actually guided the market like, I want to grow about 6.5% or almost 7%. But I think they have a range in mind, probably anywhere between 5 to 6%. I think they are comfortable with that. Yeah. And the second KPI they set for themselves is basically in terms of the research and development spending. I think China committed, on a yearly basis, they will spend about 7% annual growth in this area, especially, China these days is looking inwards, yeah, to actually to be able to be self-sufficient in terms of their technology. They don't want to rely too much on the other countries, especially after going through what they've gone through with the US in terms of the US and China trade dispute. Now, they also target to keep the urban unemployment rate within 5.5%. I think this is a very good target to have because, we talk about China, the future is about urbanization, and urbanization continue to materialize in China. And with that, right, I think they want to raise the urban resident to close to about 65% of the population. Yeah. So with the urbanization, there are a lot of long-term trend in terms of the industry will benefit out of that. Yeah, like for example, the consumer stable, the consumer discretionary, in terms of healthcare, China, because I think the next objective they are looking at is actually to prolong the life expectancy of all the Chinese people. Now with that, there will be some reform in healthcare, there will be reform in the pension scheme or the retirement benefit. And these are some of the example, the benefit of having this reform. Yeah. Now I think more importantly, China is also quite committed to this green development, especially in terms of contribution to the climate change. Yeah, I think they have actually made it quite clear that they want to move forward to that end. And you can see some of their initiatives, especially in the clean energy. I just mentioned about the the electric vehicles in China, which is you look at the number of units that they actually churn out on a monthly basis. It's just amazing, and they're actually getting higher and higher on a monthly basis. Yeah. And despite of the fact that there is shortages in the chips, for the EV, yeah. So I think the other two, target they want to do is basically to continue to promote this Belt and Road initiative. Of course, I think they are looking into more high quality development in this particular project here. And last but not least, I think China really determined to build a peaceful China. After we have seen what has going on around the world in the Western country, where you see, there are a lot of street protests, a lot of, destroyed, a lot of the disparity between the rich, the filthy rich and the filthy poor, and you see some of the social problem. I think China want to take one step further to ensure that this is not happening in China. So I think this China 14 5-year plan is going to be a significant milestone for China to move forward. Now, I want to quickly share with you some of the big picture coming from China. I think, recently we continue to hear about common prosperity. And I think this is one of the strategic direction China is going to move into. And more importantly, I think China, they themselves allow a slower growth going forward. I think, but if you look at the two objectives, right, at the same time, because they are still dealing with this pandemic, and currently they are still adopting a zero tolerance about the COVID cases. So once they detected some of these cases, right, they will take a very stern action against it. I mean, you know, they will do a lot of targeted measure to make sure that the place is again free of COVID virus. Yeah. Now, but I think again from the bigger picture here, China has been working very hard to actually trying to diffuse the financial risk, and in that perspective, right, they are working very hard to actually reduce the local government debt. At the same time, what they are doing right now is actually contain the property risk, you know, the bubble risk, which they are working right now. And in the last many years, right, they have been trying to reduce the financial banking, the shadow banking in China. So that is ongoing. I think the whole objective of doing that, right, is basically moving toward this direction to make sure that all citizens of China, right, eventually there is a housing for all of them. So that is their vision for the much longer term. Now, coming back to this reducing poverty, I think the last 20 to 30 years, China has done a tremendous job in eliminating, the poverty in China. So I think to continue with their effort, right, they are now working towards the common prosperity, which is basically to expand, the middle class. They want to make sure that, in the Chinese society, right, it looks like olive, And if you look at the shape of the olive, basically it's very round in the middle, very rich, and then the two ends is actually very thin. So they want to make sure the extreme rich and the extreme poor is a minority. The majority people are doing okay. Yeah. So that actually imply a lot of the emerging of the middle class. Yeah. And especially when that happens, right, you have to have the equal access for the public services. So this is what China is doing moving forward. Now, I also talk about the pollutions, how China is going to tackle it. Basically, they have this blue sky campaign, basically to look at the decarbonization, in terms of the objective by 2030 and 2060, yeah, to make sure that China becomes greener in future. And of course, since last year, they've been working on this dual circulation strategy. Basically, they want to make sure that in terms of technology, right, they want to be self-reliant. Yeah, that's why recently there's some tech crackdown, and that's to make sure that the global leader in China continue to contribute to the society as a whole. Now, this is where we think China is very interesting. They're fine-tuning their economy because they're actually at a crossing point of this history of the China economy and the capital market. Now, on one hand, they are slowly opened up. If you look at some of the development in China financial market, I mean, consistently, if you look at some of the index provider, for example, MSCI as well as FTSE, right, and I think they're actually taking steps to gradually and slowly monitoring the situation, and at the same time, if they achieve certain targets, right, they will start to include some of these China domestic equity market or stocks into the index, and that's actually good for the China equity market going forward. Yeah. Now that's why in the last 8 months or 9 months or so, right, you see a major reset in terms of the regulatory environment in China, whereby they actually focus a little bit, a bit on the fintech, after school tutoring, cryptocurrency. This Winter Olympics is coming, and they're trying to push for the electronic yuan, and they're actually trying to make it, acceptable to most of the Chinese, and eventually promote it to the world. Okay, let's take a step back and look at what China has achieved in the last many years, right? And the result of the reform, I just mentioned, they've done a tremendous job in terms of eliminating the absolute poverty. And you take a step back and look at the last maybe 11 years ago, right? Back in 2010, you can see in terms of the ratio, in terms of percentage, right? You can see pretty high, about 14 to 16% of the population back then is actually living in poverty. And you fast forward from that point onward another 10 years, right? You can see, by 2020, right, the number has become very, very small. That that tells you, how effective, China in terms of, their reform in terms of removing this, the poverty in China. But having said that, I think, if you listen to the recent speech by Premier Li Keqiang, right, he basically says that, if you look at some of the statistics, right, the China average income per capita actually stood around the renminbi about 30K per annum, yeah. And then you have about 600 million people, 600 million Chinese people earning just about 12K per annum. So there's significant opportunity to actually improve their earning going forward. That's why, they started to talk about common prosperity, how the super rich, technology company can actually start again contributing to the society as a whole. Now, if you look at the number of frequency in terms of this term mentioned, right, by the Chinese leader, if you compare the frequency between year to date this year versus last year, it almost had double. Now, last year, right, I mean, officially someone recorded this, and last year it was about 25 times, the leader talks about it. But on a year-to-date basis, only as of end of August, right, they already mentioned it more than 60 times. Yeah, so I think, they really want to make it happen, and this will be the strategic objective of the central government coming from China. Now, next chart, I have this China Wealth Gini Index. Now, the Gini Index basically tells you, the situation, the disparity between the very rich and the very poor. Of course, if the number going up is not good, that means, the gap is widening. As a matter of fact, China actually see that the gap sort of like come down a little bit anywhere between 2014 to about 2018 or 19. Again, recently there is a spike up, and I think it caught the attention from the Chinese leader. I think this is where they are starting to look at some of these tech giant, which has made a lot of money in the past, right? And to see or to make assessment whether how this technology company can again contribute to the society as a whole. Now, we talk about the crackdown this year, but if you are a student of history, right, you will realize that this crackdown is nothing new. In the past, right, China has actually embarked on a various type of crackdown. I mean, in the mining industry, the dairy products, the high-end dining, the liquor, recently the gaming, especially the pharmaceutical in terms of the drug prices, right? And they have done that quite a fair bit over a period of time. And especially when that particular sector actually has gone through a significant growth or explosion. Now, I think what's more interesting is that if you look at the duration of the regulatory crackdown, if you just compare the latest three crackdown versus the previous three, you can see, you will realize that this is one of our observations. We realize that the period, right, is actually shorter compared to those crackdown in the past. Now, the crackdown started in February, and we are already in the 8 months, yeah. And you can see, it's pretty much, if not they're at the end of it, right, we don't think it will drag on forever or any longer. And simply because if you look at the China, in terms of their economic growth, they are actually slowing down, and too much of the regulatory crackdown may not be good for that. So we do believe that at one point, they will slowly wind down all this crackdown, and hopefully by then, we'll see a better equity performance from China equity markets. Now, I want to quickly talk about this China policy, in terms of the objective. Basically, we understand that they want to balance the growth and also to do it in a sustainable way, in a very safe manner. So that's why I think if you look at this focus, the policy focus they have, right, basically it cover under social, national security, the financial, as well as the environment. Now, I just want to quickly focus on the social aspect of this. Now, you can see that, under the social, right, you have this tech giant, basically to tackle the rising tension of the social inequality. Some of these tech giants actually take advantage of the worker because the gig economy. So it's not like a real permanent employment, So in terms of benefit to some of these, gig economy workers, right, I think China feels that, this tech giant can do a better job. especially when it comes to the quality of their services in terms of their benefit, whether the insurance is covered, and in terms of giving them incentive. I think this is where the central government thinks that the tech giant can do a better job, and that's the reason of the crackdown recently, especially for like Alibaba, Meituan, and some of these platforms provider, yeah. And of course, the education. Basically China has banned the private tutoring after a normal school. Yeah, that's why you can see the collapse of this private education altogether. Yeah, I think they want to make sure that the education going forward will not focus in getting you into the university. They want to build a more well-balanced future of Chinese, yeah, new Chinese citizens. Housing, they are actually working on it right now. Healthcare, we strongly believe, this is not the end of it. We strongly believe that the regulator, again, they will move into the sector industry like the healthcare or insurance and pension. As I mentioned, some of their objective, basically, the next 5 years is actually to expand the life expectancy. So definitely you need to look at the pension, look at the retirement, and this is where the reform is going to make a difference, yeah. Now, I mentioned about this new regulation. Of course, any regulation in the short term will not be good for the earnings for the company that they are affected under this regulatory crackdown. Now, say if you are a company under the cyber security, or whether you are in the platform businesses, or data security, or even for social wealth distribution, any of the company fall within this particular sector or industry, right? In the short term, basically it's all very negative because the margin will be reduced. The earnings going forward in the near term will be reduced. So these are the impact in the near term. But we strongly believe that if you see beyond the short term negative impact, right? We do believe that China has the ability and capability to maneuver this and some of these new developments that will make some of this company to be even more innovative. I'm sure they will navigate this uncertainty to come up with even solutions to make the company stronger, and in terms of the quality earning even better. Now, after the crackdown, we can see the China market actually has moved south as compared to some of this developed market in US, Europe, or even Japan. Now, even compared to the emerging market, the China equity market as a whole, right, has actually underperformed quite significantly. Yeah. Now, having said that, I think if you just drill down a little bit in terms of the China equity market, no doubt, they have came down a lot. But if you really look into it, right, basically a lot of this sell down basically concentrate on the internet company, company that involved in the education sector, as well as some of the Chinese company listed in overseas, for example, in New York Stock Exchange. I mean, a good example with Didi, the ride-hailing company. Yeah. But having said that, we also see some positive development in the China domestic A share, particularly. Now, if you look at this chart here, right, you can see, even the Islamic China A share, the A100 index, right, still give you a positive about 3.02% as of end of September. And if you look at the Shenzhen, the Chinex company, which look at the top 300 largest and most liquid A share in China, right? They actually have done quite well on a year-to-date basis, which give you about close to 10% sort of a positive return. And again, if you look at the China equity market in a medium to long-term basis, right? We are still pretty confident that this sort of long-term performance can be maintained. And if you look at the performance of some of these indices, right, especially in the China A share market, they are giving you pretty solid, double-digit return. Yeah, even for MSCI China index, it's still, on a long-term basis, the last 10 years still managed to give you a annualized return of close to about 8 to 9%. Yeah, these are the solid, long-term performance. We sometimes sort of forget about it, because probably we are in the down market and we just so focused on the short term, and we forget about the long term performance of the market itself. Now, this is the performance for our Eastspring Investment Dynasty Fund. You can see, early this year for the first 2 months, the fund still, have a very strong positive return of double digit. But since then, of the regulatory crackdown, and it continued to come down to where it is about, I would say, close to negative 10%. But bring you back to the long-term argument of the China equity market, or even giving you the performance of our equity dynasty equity fund in the last 10 years or since inception, and a solid annualized return of about 10%. Again, I think this is a very attractive number to look at for long-term investment. I mean, we should take this market sell down, as an opportunity to reposition for the medium to longer term. Yeah. Now, let me just give you a little bit more color in terms of the fund we manage. I will skip on the those basic information. I will quickly go into the focus in the next couple of months for us. Now, the fund continue to favor the domestic consumption play, right? The consumer discretionary as well, the consumer stable segment of the market. Especially, the China has just gone through the long Chinese holiday, and we see a lot of positive development in terms of the spending. That's why we have stepped up our exposure. I will talk about that later on when I look at the portfolio constructions. And we continue to like IT as well as the e-commerce and healthcare sector. Yeah. And because of the volatile market, we continue to have this barbell approach, balancing between the defensive and growth stock that we have, while riding through these structural changes in China. Now, these are the fund performance 1 month. For the month of September, the market dropped, negative 3%. But I think if you look at from the longer term perspective, 3 years or 5 years, I think the fund still give you a pretty attractive return. I want to just talk to you about this risk statistic in terms of performance for 1, 3, and 5 years. You can see, the number here actually are the standard deviation and risk adjusted return. Now, for 1 year and 3 years, you will see, for our dynasty fund, standard deviation is higher compared to the peers group. But in terms of the risk return, also slightly lower than the peers group. But what I would like to emphasize here is that the dynasty is actually an Islamic Sharia fund. And because of that, right, the exposure to technology is a lot higher compared to conventional fund. Yeah. And more importantly, for Sharia fund, we don't have the exposure in financial market. And as the economy continue to recover post the pandemic, right, we have seen some of this cyclical sector, for example, like financial, has done quite well and recover. And because we don't have the participation of that, right, so our fund actually have been slightly lagging compared to our competitor. But having said that, if you look at the longer term perspective, like 5 and beyond, right, you can see our standard deviation by and large is lower than the peers group. And in terms of risk adjusted return, we are also slightly performing better. Yeah. So because the nature of the Sharia of the mandate, so when the technology go through this high volatility uncertainty, right, it has affect the performance in such a way that it's also more volatile compared to the conventional one. Now, let me just quickly give you some idea how we actually have repositioned the portfolio. Now, as of today, right, we have stepped up our exposure in terms of the equity exposure. End of September, our cash exposure was about 6%. But in the last 28 trading days, right, we have actually stepped up the exposure. We have reduced the cash from 6% to about 2.5%. So we are almost like fully invested now in the equity market, the China equity market. And as a result of that, we also benefited from this rising market. On a month to date, as of yesterday, the fund registered close to about 2.85% positive return. Yeah. So if you ask me, what do we see in China equity market as a whole? We still strongly believe of the structural growth in China for medium to longer term, yeah, despite the short-term volatility, and that's very important. And we still believe that as the China economy continue to recover, even though it's a lot slower than expected, right? We still see a lot of pocket opportunity in China at the moment, especially they've gone through this period with United States going through the trade dispute, you know. And because of that, right, the China's strong push towards self-sufficiency in terms of manufacturing, industrial good and semiconductor, as well as their commitment into ESG compliance and the climate change, we strongly believe that a lot of this new economic sector, which is supported by the policy maker, right, we do see, you know, in the medium to longer term, the better future for China as a whole. So with that, I'm going to stop my presentation here, and you know, I'd be happy to take any question as you know, if you posted. Yeah. Back to you, Jiajin.
All right. Thank you, Ken, for the insightful presentation. So let me see which is there any question from our audience. So I see one question. Due to the Chinese government crackdown, technology stocks listed in Hong Kong have plunged drastically. Going forward in the next 6 to 12 months, right? What is the risk and opportunity in investing in Hang Seng technology sector? If the audience want to invest now, what is the risk and opportunities?
There are always risks in investing in anything anyway. But I think you know, if you look at my presentation data that I just shared with you, you can see that, you know, the recent crackdown in terms of the period as compared to the previous crackdown is a lot shorter right now. We are already in the 8 or 9 months of that crackdown period, and we strongly believe that it will not, you know, go on forever. At some point, they are going to have a compromise, or I mean, you know, the tech company that they've been affected, right, has been really working very closely with the regulator. You can look at Alibaba that accepted the fine. You look at Tencent that actually, you know, followed the guidance coming from the central government. Even, you know, the Evergrande, you know, the regulator steps in, but they didn't rescue the company, but they actually provide guidance to the market, provide instructions to the player what to do. For example, you know, disposing some of the assets, you know, under the group, and even come to the point, right? The regulator actually says, it tells the owner, not the owner, but the managing director, who is also the founder, to use his own personal wealth to settle some of this debt payment. So this is, you know, China is very different, because when the central government says something, right, usually it will be followed very closely. So I think I don't know when, you know, this thing will stop completely, but I think, you know, in terms of the risk, right, it is a lot lower compared to beginning of this year, yeah. And we are seeing they are step up and speed up a lot of some of this action that they are doing right now. So and if you look at the market sentiment, actually slowly coming back. And if you look at the performance from, I just mentioned, right, for month of October, we're actually seeing some positive return coming from the market as well as the fund. So I think the risk has reduced significantly, and of course, depending on, you know, when you invested in this dynasty fund. But I strongly believe this is a better opportunity for you to pick up when the NAV of this dynasty has been corrected quite a fair bit to where it is now. Yeah, and I strongly encourage you to take this opportunity to relook at the dynasty fund again. I mean, you don't have to take a lump sum approach. You can, you know, space up your investment strategy. I think, you know, you will see some of this positive result in the medium to longer term. Now, you look at some of these companies, you know, for example, Tencent. I think some of their losses in the last few months is actually stabilizing, and you are seeing some of these share prices actually move up a little bit more now. And we strongly believe that, you know, this company are quite adaptable. They are quite innovative, and they will come up with some innovative way to actually navigate this. And this is where we strongly believe that, some of this company with strong fundamental like Alibaba, Tencent, JD.com, will survive this, and not only survive in the medium to longer term, they will continue to perform. And especially when the evaluation now is very, very attractive. You look at Alibaba, the PE, very low single digit, But you look at their cash flow, very, very strong. I mean, I'm not saying that you invest today, it will collapse, but I think the chances of you making a mistake now compared to like 6 months ago is much lesser. So at this juncture, I will encourage you to gradually take a step, to start investing again.
All right,
Jia
thank
Jin?
you. All right, so the next question will be, how do you compare A shares and H shares in terms of risk and opportunity?
Okay, China A share, it is not widely sort of understood by a lot of the investor, and I think one of the reasons is because in China domestic market, a big chunk of the investors are still retail. Whereas for H share, it is slightly different. It is more towards the institutional investor. Yeah, but I think things are slowly changing, and also some of the positive development coming from the index provider, the like of MSCI and the foresee, right? They are, if you look at the last couple of years, right, they have been progressively, right, increase the China A share weights in their indices, different indices, be it on the emerging market, the China index, and these are very positive development, meaning to say that as they step up the increase the weights, right, and there are a lot of institutional investors who buy into all these ETF or even index, right, will have exposure to that, and that is a very good thing, because you are seeing that the presence of the institutional investor increasing in China domestic market, and which is very, very important in our opinion. So in terms of valuation, of course, those listed in Hong Kong H share, for example, Alibaba has been beaten down so badly, yeah, and it becomes a value stocks right now, yeah, and because the PE is so low. But then again, you look at their different businesses, they're still growing. It's just that because of the regulatory crackdown, they have to adjust a little bit, yeah, to make sure that certain policy that they have, right, is not being abused. I mean, I give you an example. If you're a worker involved in gig economy, you don't depend on a fixed salary. You just depends on the consumer feedback for incentive, and because of that, there are a lot of abuses in China previously. For example, if you are slow in your delivery, and when you are marked down with your rating, right, and then your incentive will be gone. And I think there has been increasingly you're hearing a lot of complaints from all these workers. So this is where the regulator steps in to make sure that all these workers in the gig economy will not be abused in future. So I mean, if you yourself involved in this economy, you also want to have certain assurance, right? Make sure that the company you are working for, right, give you some form of like incentive, a fair one, as well as give you some adequate coverage in case of anything happen to you. So this is where the social well-being and the equality comes to the picture, and we are seeing that is a very positive development.
All right, thank you for the explanation. I think we take 2 to 3 more questions.
Sure.
So there's another question. China market has been very volatile. How do we manage the risk to make it like less volatile? How do we do the risk management?
From a portfolio construction perspective, we actually use a barbell approach. Of course, you don't want to put all your egg in one basket. You don't want to put everything in the growth company. You still want to have some exposure in defensive stocks. Now, defensive stock, what I mean is that they are the very strong fundamental company that perhaps have very strong cash flow to weather, when the times are really bad, they are able to have enough cash on their own to survive that. And this is where what I mean by defensive. And defensive on the other perspective also can refer to company that give you a little bit of dividends. Yeah, and these are the matured company in terms of their cash flow are very strong. They are not affected by a lot of this so-called the pandemic out there. For example, in the consumer stable segment, despite the pandemic, about the virus, the economy locked up, right? There are still opportunity for them, or even because of online platform, they continue to prosper or continue to grow their market share and their bottom line. So these are also the company we look at to make sure that when we have that on a portfolio, anything happen out there, the market become volatile, and these are the company usually are a lot more stable, and in terms of their prices, they don't move so much. So we actually have a combination of defensive and growth. Now, when we get the strong signal that the economy is going to recover and earnings is going to be revised upward, right? Then we will fine tune it a little bit by reducing our exposure in defensive segment and move more towards a growth sector. Or if we are seeing more headwind ahead of us, right, then we adjust the portfolio in such a way that we reduce the weight in the growth and move more to the defensive sector. So that's how we manage the risk in that perspective.
All right, thank you so much. So the next one will be, do you foresee a much higher percentage of A shares being invested in the dynasty funds to take advantage of the common prosperity policy?
Oh, certainly. I think we already started embark on this journey, and I think dynasty has actually stepped up in terms of the ASA exposure. Now, having said that, we have also launched exclusive China A share. Yeah, it's called the Eastspring Investment Islamic China A share equity fund. Now, there is a strong demand coming from the distributor, and we launched it last month, and we already locked in more than I would say 50 to 60 million right now. So we continue to see the cash coming in as a result of the interest from the investing public, and of course as China start to stabilize, and we think that there are a lot of opportunity coming from the China A shares. Yeah.
All right, thank you so much. The last questions. In terms of overall risk in the medium terms, do you have some insights on the difference between dynasty fund and the new Shara China A shares fund? Is that the same with the one you shared just now?
Okay, very good question, because I mean, these are the fund invest in China, doesn't mean that they have the same risk category. Now, if you ask me to compare which is more risky, I would say dynasty fund may be a little bit more risky in terms of the risk profile, simply because, as I mentioned to you, right, being an Islamic fund, you have no exposure to the financial sector. Now, financial sector is a still pretty important sector, because as the economy continue to recover, right, and usually the first sector that will benefit out of that will be coming from the financial sector, be it on the commercial bank or investment bank or insurance company. Since we don't have that exposure, right, the only thing that we can focus on in other sector, and it happened that for Islamic Sharia fund, right, the exposure for technology is higher compared to conventional. Yeah, so in that perspective, right, because of the volatility in the technology sector, because they are growth stocks, if they are right, they can move very fast. If they are wrong, they can move down very fast as well. So because of that, I would think that dynasty is more risky than the recent launch A share. And if you look at the breakdown of the index, right, and we can see that for China A share, right, is more diversified, yeah, as compared to the dynasty, whereby the focus is actually more on the technology. And for the benchmark for the other one, most of the sector are rather diversified, yeah. So because of that, I would think that in terms of the volatility, yeah, the risk profile, the China SA domestic will be slightly less compared to the dynasty fund.
All right, I think we will stop here. Thank you, Ken, for the insightful presentation and sharings for all the questions. If you have any further questions, feel free to send us an email at invest.myalliance@fundsupermart.com. A replay of today's session will be available right after this. Head over to our YouTube page at FSMOne Malaysia to catch this replay. We will be having another webinar session with M Invest on next coming Tuesday, 9th of November, where we will be talking about global agribusiness. If you haven't registered for the event, please head on to our website now at www.fsmone.com.my to register. Once again, thank you very much, Ken, for joining us today. And thank you everyone for attending today's session. Have a good weekend.
Thanks, Jajin, and thank you everyone. Good night and take care.